Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, who is tax partner at GRF CPAs and Advisors here in Bethesda, Maryland. And my business partner, Corby McGordon, is joining us today. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value, and then for planning your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. An issue that is consistent and very important, but often overlooked by business owners when preparing their business for sale, is working capital. With owners we've worked with, there has been at least some confusion as to how working capital should be considered or treated, if not total neglect due to ignorance until the sale of their business is actually being negotiated. So we want to try to bring some clarity to that issue today, because it is important and often overlooked planning issue. And so the topic today is working capital and preparing a business for a business sale negotiation. So Walter, I'm going to look to you to kick this conversation off. How should we get started here today?
Well, let's just start kind of with the basics. So number one, it's really important for a business owner to recognize that one of the aspects of the sale of their business is going to be that the buyer is going to expect them to leave in the business sufficient working capital so that when that new owner steps in the door, the business is ready to continue performing. In other words, I'm not going to buy your business, show up, have no accounts receivable, no money in the bank, and I need to all of a sudden put more money in just to get it going. Yeah.
So to that point, real quick. So like if I'm going to buy your business, I come in today or actually let's turn the tables. You're going to come in and buy my business. Me, the seller, I can often think that the only check you're concerned about writing is to check for the value of the business, to buy the value of the business. But me as the buyer, I'm also thinking there might be another check I have to write, which is for some operating capital, depending on the negotiation here, to keep things going.
Right.
That's what you're talking about, right?
That's what I'm talking about. Yeah.
Mm-hmm.
So it's important to, just give you a real life example. I had a client recently sold their business for $8 million, but they were expected to leave in the business $1 million of working capital. So you can see, one reason we're hitting on this today, we feel it's important, is because you're playing golf with your buddy and he's like, hey, I've just sold my company for $10 million. Well, as we've talked about in other podcasts, we know he's paid taxes. We know he paid professional fees and maybe even a brokerage commission. And then he also had to leave in some level of working capital. So, this is just an important aspect of going from the gross sales price to the net sales price, because the net sales price is the one that you're counting on when you're doing your retirement planning or whatever your next stage of life is. Mm-hmm. So it's just working capital is a really important feature of the net proceeds that a business owner is going to realize.
So Walter, most of us are not accountants, and I even looked up, what is working capital? And what I got was an equation.
Yeah.
Can you tell us in just kind of street terms, what the heck is working capital, and how does a business owner figure out roughly what working capital is / should be?
Yeah. So working capital is basically, it's a measure of the liquidity of the business. So when you're looking at it, it's like basically, how much cash do I have in the bank? How much receivables do I have on the books? And what do I owe in payables? So in other words, what is your cash position right now if you collected all your receivables and paid all your payables? Mm-hmm. Mm-hmm. So the idea is that, and then for purposes of a sale, usually what happens is the buyer will look back and he'll do that calculation, current assets minus current liabilities, and he'll average it out for the previous 12 months normally. Mm-hmm. And whatever that average is, that's the amount he expects you to leave in the business when he takes over.
Yeah. 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 So practically speaking, if you relate it to household budget, you may have like a ready savings account that you're going to get paid by your employer, you got bills to pay, and you're going to chunk stuff in retirement, but you want a operating fund, if you will, in a savings account that's just going to help you keep the bills paid and maybe cover some contingencies, and that you're comfortable that you're not going to run out of cash.
That's exactly right.
Okay. Very good.
Yeah, that's a really, really good way to look at it. And it's also, it's interesting because it's a fairly substantial part of the negotiation for the sales price.
Mm-hmm.
And it's also, it can be a real point of contention, because usually what happens is the sale agreement will say that within 30 days of closing, an analysis of working capital is done. So if I promise to leave you $1 million in working capital, there's going to be an analysis done 30 days later to see how much I really left you.
Mm-hmm.
And it'll have to be trued up. Maybe I'll get money, or maybe I'll owe you money. But it's really important for that reason that the calculation is spelled out in great detail
Mm-hmm.
in the purchase agreement, because there's lots of little things that can impact it. So for instance, you've got to spell out that your working capital is going to be calculated based on accrual basis accounting, for instance.
Mm-hmm.
I mean, it seems logical, but you need to say it.
Yeah.
One area where we often run into problems would be deferred revenue. So for instance, you may have a client who hires you to do a project, and it's going to be like a 1-year project, and the terms of the contract call for them to maybe pay 50% up front.
Mm-hmm.
But you sell your company and you're only 2 weeks into the project. Well, you've got cash in your bank account that you may think is part of your working capital.
Mm-hmm.
But the buyer is like, hey, wait a minute, I got to come in and do half of this project, and I'm not getting paid for it. So you need to adjust for things like that. So it's definitely a major part of due diligence, and there can be contentious discussions over it.
Mm-hmm. Mm-hmm.
Yeah. So let's say that at the beginning of the negotiation process and selling a business, that there was $1 million in working capital. And so that was factored in, that's been factored into the initial offer price. And then you get to within 30 days of the actual transaction. And to your point, they do another analysis, and there's only $500,000 in there because the owner decided, I'm going to take a little bit of cash out of the business.
Right.
Well, that's a problem right there. But then too, of course, it's going to impact the final sale price that's negotiated.
Yeah.
And the other thing that occurs to me is, often occurs, is that we often talk to owners where the third party sale is the right exit route to accomplish all their goals. We just make them very much aware of the due diligence process and how intensive that can be, and how important it is for them not to get their eyes off the ball, so to say, and running the business and doing everything they do regularly to make the business successful, driving revenue and everything else. Well, if they take their eye off the ball during the due diligence process and during the negotiation phase, and the business starts to falter some, that working capital piece could shrink as a result of that, right? And then hence impact the sale of the business.
Yeah, and I think well, let me just throw one thing out that it's kind of an interesting phenomenon we're seeing recently is, a lot of businesses got PPP money, the Paycheck Protection Program money. And because there's a little uncertainty as to what, if you didn't really necessarily spend it all and you still have it, Some people are being pretty conservative because theoretically, the SBA has 7 years to determine if maybe you shouldn't have gotten the money or not. So some people are being pretty conservative with that. So we're actually seeing situations where, like some business valuations I've been doing recently, there's actually excess working capital in the business because they've got this PPP money sitting on the books. So in some cases, a business owner could sell their business, in my example, for $8 million, and there may be $1 million of excess working capital they're going to get on top of that. So that's just a weird phenomenon we're seeing right now. But back to your point, Pat, which I think is a really good one. And something you've said ever since we started these podcasts is good exit planning is nothing more than good business planning. And it's really, really true. It's been very, very true in this situation when you talk about working capital, because I'll just give you an example. If you do a horrible job of managing your receivables so that, you're lucky if you're getting paid in 90 days, that's going to increase your working capital requirement, because the person who takes over your business is not going to be able to count on collecting receivables in 30 days. So, there's things like that. And I think Corby can talk to probably some of the best practices that you guys institute for your clients, who you pretty much, act as their CFO. Because I know, your big focus, I know Corby's big focus is cash management and cash flow.
Mm-hmm. Yeah. Yeah. It's funny how often we get the question of how much cash should I retain in the business? I take that as a proxy statement actually for, what type of working capital should I have available? And, there's this common rule of thumb of, well, you should always have 3 months of operating expenses in the bank. Well, as a classic consultant answer, it depends. But, one of the reasons why at times it can be difficult for an owner to put a finger on it is because they don't have timely books. Their books are not closed mid-month. They're not clean. So therefore, to understand trends becomes very difficult. And conservatism would say, well, you just need to keep more in there. So counterpoint to that then is measuring the right metrics. And too often it's just how much cash do I have in the bank, ignoring in a sense receivables and payables. And the simple math of there's the technical terms of days sales outstanding, days payable outstanding. It's a simple matter of if you do $1 million in revenue and you normally have on the average 100K in receivables, well, you've got 1/10 of the year, i.e. 36 days of revenue in receivables outstanding. But if that metric remains solid over time, it gives you a great basis to argue for only leaving X amount of working capital in the business, because you can actually prove to a buyer that, hey, our practices are that we average 36 days, we get paid. As you said, Walter, if that's up at 90, boy, that's a quarter of a year, of cash flow. And if you're growing, that compounds.
Buyer wants to see fast money coming in and slow money going out.
Exactly.
So as valuation guys, let's say you were buying a business and it was a business that you as valuation guys, you look at it, you're doing the financial due diligence, and you recognize, what, this is a business that indeed should have about 3 months of operating expenses in working capital, not 6, not 8, not 10, but 3. And indeed, you're looking at it and they've got, well, you could go in 2 ways here, but let me go in this direction first. Let's say they've got 10 months of working capital when really they only need to have 3. Does that raise, as buyers of the business, what questions would that raise in your mind in regard to how the business is being run efficiently or effectively?
I guess it depends. I mean, I had this situation recently where they have a lot of excess cash in the business, and I asked them about it. And, the owner is not insurable, and they just felt like having that extra money in the bank if something happened to her, from like a disability standpoint or something. Since she couldn't have any type of insurance proceeds kick in, they would leave it in there. So that made sense.
Mhm.
I think sometimes you tend to see, it's my experience, and Corby can speak to this too. I tend to see more situations where where business owners are using their business as their personal bank. So they tend to be short on working capital. There's not extra, but like I said, the PPP money's turned that around a little bit. But you definitely need, it's definitely a bit of a red flag if there's very little working capital and they're just getting by month to month, and the business owner is kind of stripping all the income out.
Mhm. Yeah, and I think to that question, if I'm a buyer, like the example Walter just used, if the seller can give a reasonable answer, then that's easier for me to accept.
Mhm.
If the answer is vague, there's kind of a shoulder shrug. Well, I'm not really sure. Well, that would say to me, okay, there's more risk. Therefore, I'm going to press for keeping more money in the business as working capital because I'm assuming that risk.
Yeah.
So some of that is, to a degree, the clarity of a negotiating position. And that's no different than, managing day-to-day operations. Of variance in and of itself in budget versus actual isn't that big a deal. The big deal is if you don't know why. That's the problem.
Yeah, that's a
Yeah.
great point, because, if you come across as being unsure as to why you have the amount of working capital that you have, me, the buyer, I'm going to start to wonder about, okay, well, what else? I wonder what else they're unsure about. If they're unsure about how much working capital they have, how sure are they about everything else? And
Yeah.
it's critical in regard to running their business.
Yeah, and that's, we talk about doing your own seller due diligence before you put your business out there. And this would be part of it. You would do your own working capital analysis for a couple of reasons. One is so you're not blindsided by the question. And number two, you want to start to get your arguments in place as to why the working capital requirement should be smaller as opposed to larger.
Mhm.
And, along those lines, a really good point Corby made, is just this whole concept of knowing where your business is month to month. Because if you're looking back, if a business owner really isn't on top of their financials month to month, and a buyer comes in and they're looking at your average working capital on a monthly basis, it's going to be kind of screwed up because, it may be, a lot of our smaller clients, they just kind of run everything cash basis, don't really make a lot of entries every month. And then the end of the year, they'll make a bunch of entries, and they may even, pay a big bonus or pay employee bonuses or profit sharing, that type of thing, which is going to make so you can have 1 month with all these adjustments to working capital when really you could be allocating those ratably over the year, which is going to give you a much more accurate idea of your month to month working capital needs.
Well, that's a great tee up for our strategy renovation value advisor engagement, because that's foundational to what we do in that month to month engagement.
Yeah.
Is Corby helps the owner stay on top of that stuff the way they need to stay on top of it. Corby,
Yeah.
would you add anything to what Walter just said?
I just, in terms of, amplification, I'm thinking on that owner that uses the company as a personal bank. A lot of owners do it. It's not necessarily wrong, but again, the issue is what is in your mind, and what is the surety that a buyer would have that your numbers are accurate. Some owners choose to just pull more out, maybe invest it so the cash isn't sitting there, but they're fine with dumping money back in if needed. It kind of gets back to the provability of the soundness of your financials, so your argument is in place. And the other thought is if you have a projection of growth, again, that working capital, in a sense, you're projecting working capital needs to be higher. because the business is going to grow. And, just kind of have that little asterisk in mind because, a buyer will surely think that and go, hey, if we're going to grow it, you're saying you're going to grow at 20% a year. Well, guess what? I need 20% more than history.
Yeah, well, that's another reason, isn't it, to stay on top of these things monthly, because it helps you with all the forward looking strategic planning, to stay on top of that, and
Yep.
helps you to make those strategic decisions.
Yeah.
Walter, you mentioned working capital analysis. Is that, if the listeners out there are thinking, okay, yeah, great, I need to do, I want to do that, I need to do that, how would they go about doing it?
Well, if they want to take a shot at it themselves, what they really need are, if they use like QuickBooks, for instance, they could look at their accrual basis monthly financial statements, assuming that they've, made the appropriate adjustments month by month. If they haven't, they should do that. And then they could go through that simple calculation: cash plus receivables minus payables, and kind of get an idea of what their working capital is. Average that out over 12 months, and that kind of gives you a ballpark. Then you need to go in and, tweak it for unusual items, like maybe you had a big IT upgrade, or, something like that that's not going to be repeatable, or an unusual professional fee, something like that.
Mm-hmm.
Yeah, so you almost normalize the working capital.
Exactly.
Well, I mean, in a sense, Walter, it's really the same exercise as when you're doing evaluation. You want to identify the abnormalities, make the adjustments, to Pat's terminology, normalize the statements, and then simply do the math and see what's that trend been.
Yeah, that's exactly right.
And again, I think it's important. A lot of business owners will run P&Ls that are this year versus last year, which is fine, but the trend of your metrics are also very important. Again, making the case for the monthly analysis, it is, hey, my trend has been, my days payable is going down. My days receivable are going down. My net bottom line is going up. Just so not only is it a snapshot in time, or, a snapshot of 12 months, but it's over history, our performance has continued to improve, because, those are the vital signs of healthy business.
Yeah. It's interesting, I think, and I'm sure you see this a lot, Core, because it's one of the things that your whole system helps to kind of fight against. But most business owners are focused on, they keep track of how much cash is in the bank, but then they're really looking at our sales, and is our sales going up, that type of thing. They don't really focus so much on the different balance sheet ratios, which are really the critical indicators of the company health.
Mm-hmm. Yeah. And again, it's understandable, because, the balance sheet really reflects the income statement.
Yeah.
To a degree. But, where I keep it, real simple is, we look at the trends of cash balance, look at the trends of receivables and payables. And if they're stable, then it's real easy from a P&L perspective to interpret the health of a balance sheet, because I think for most business owners, a P&L is much more approachable. It's much more understandable, if you will.
Yeah.
But, and then, you've mentioned in passing, that the top line is going up, but I think it's also critical that the gross margins are remaining the same, or improving, and that the net is maintaining or improving, because that's what's really going to affect your balance sheet, is the net, not the top line sales.
Yeah. Okay, guys. So the last few minutes here, any last thoughts on problem areas, or, important metrics, anything like that, or anything else as we close?
I think Corby hit upon it, and I hit upon it, is that going through the analysis ahead of time, especially to identify normalizing adjustments, especially ones that are in your favor, because it's always going to be greeted with suspicion if, if your initial meeting, you say, yeah, our average working capital needs are, we usually have $500,000 every month. And then next time you're meeting with the potential buyer, you're like, hey, guess what? I've run through the numbers and it turns out it's really only 250. They're going to wonder, gee, well, I wonder what just happened there. So, it's just, you really want to, and it could be legitimate, but because you started with a different number, it just looks bad. So it's like, we say, I think pretty much every week or every 2 weeks on this podcast, you really need to be prepared as the seller. You really have to have all the answers to any potential questions, and you really need to do your pre-due diligence, anticipating the type of questions that are going to be asked of you.
Yeah, the buyer needs to know that you know your business, right? And that you're not just crunching numbers in the last 30 minutes before you go to the deal table to figure these things out, but that you can answer them with confidence and conviction.
Well, just a simple approach. When I do an analysis of a company, I start with, I want 36 months worth of P&L from QuickBooks, all in columns, so they're side by side. And I simply scan every line for normalcy, if you will.
Yeah.
If I see abnormalities, it's highlight that and ask why. But if an owner does that and knows the why, so to Walter's point, if there's some big, expense in any given month, it's flat and all of a sudden pops up. And once you put the figure on that once, 2 years later, you're going to remember. They're going to go, what's up with that? Well, that was big IT expense. That was this, that was that. And just the discipline of doing simple analysis that doesn't take a CPA, doesn't take a financial analyst, but just that number is a lot bigger or a lot smaller. What happened? Knowing that and keeping short counts on that, it's easy prep for due diligence at any time.
Yeah. Yeah.
All right.
Sure.
So let's wrap up with 3 next steps or action items for listeners. What are they? Number one, what's number one?
I think number one is, to the extent you're able, really generate useful accrual basis monthly financial statements and review them.
Very good. That's a great answer.
Yep.
To number one. What would be number 2? Is there a number 2?
Number 2 to me would be inconsistencies, dig into them, understand them, and document the reason why. That way you've identified it, you're ready to hand it to a potential buyer and go, here's why.
Yeah.
Right,
Yeah, and I think number 3, just like we tell business owners, like before they engage with you guys, to start growing the value of their business, it's good to get an estimate of value, to have a baseline. They should do the same thing with their working capital analysis. Go ahead and do one. Doesn't have to be perfect, but at least it gives you a baseline, and then you'll understand what's driving it, and you'll find ways to improve it as you go through time.
Excellent. Okay. You know what? I'm not sure if we've done an episode. If we have, it's been a long time ago, probably, on cash flow analysis. I think doing an episode on cash flow analysis would be as helpful as this. And even if we've done it before, it'd probably be a good time to revisit it. So maybe we'll do that in the next episode or 2.
I know a guy you can bring in for that. His name is Corby McGordon.
Yeah.
Wait a minute.
All right, good. Yeah.
Love to do that.
All right, guys. Thanks. Fantastic. Great content. You guys have knocked it out of the park. Listeners, if you want help in planning for your eventual exit, you can access virtual planning resources at exitreadiness.com. And you can also reach out to us through that site, exitreadiness.com. If you go there and you set up a free account and decide that you want to buy one of the virtual products there, and you use the code podcast all caps, you get 10% discount. So until next time on the Exit Readiness podcast, this is Pat Ennis and Walter Dial signing off.